this is our economic calendar for today. And as you can see, we have Draghi doing his bit. 8:30 a.m. we have medium impact import prices. And 10:30 we have crude oil inventories. So we'll have something to watch around 10:15 going into 10:30. So there will be a second session today, just to watch the impact on the crude oil inventory numbers. It won't be a long session then, but this teaching or session is going to be a little bit of a teaching session. I gave you a case study last night. Let's go over to it. You should be, I'm not sure if it'll let me do this, but does it show the forum? Okay. All right, so what I gave you was a case study looking at selling short on a rally, but it has to rally above the opening price. It has to go up 10 to 20 pips. Now, do we sell just 10 to 20 pips, or do we look for something else? You look for a IPDA array, something, well, if we're looking to go short, if we want to sell the idea that we're looking for a move down into the lower fair value gap on the daily chart, we're looking for basically and forecasting the Judas swing that would occur if we were naturally sitting up during London. Okay, so we're looking for something that would give us a reason to get short, or what we would reasonably expect to see unfold should we sit up and watch the London session. So while we're anticipating a move above the opening price to form some measure of a high, we also have to couple that with some measure of premium. Okay, so that's going to either be a bearish stochastics, a Bollinger Band, a supply zone, something like that. I'm just kidding. I'm just kidding. What you're looking for, what you're looking for is like a fair value gap to close in above market price. You're looking for a bearish order block, a rejection block, an old high to run for buy stop, something like that. Okay, so the filter is we want to see it rally. Okay, we want to see it rally to some measurable premium level. Okay, so I'm going to go through today and teach you why we kind of look at 0 GMT over the New York Midnight, or why we look at New York Midnight over 0 GMT. So I haven't really talked too much about that discussion, so I want to kind of use that today as a medium. So I gave you the case study to look for. Anybody in here participate on this pair? Okay. All right, so let's go over to, hang on, let me get this chart on the screen. It should be, you should be able to see it now. It should be the dollar index. Okay. All right, so we have the dollar index. We've seen it close later on after I did my session recap yesterday. It traded up, closed in the gap, and today we tried to make an attempt to run through it. Since then, have failed. Okay. Doesn't mean we can't drive through it later on with the crude oil inventory numbers, but it may be the catalyst that's required to do that. Euro pound, we saw it trade down, close in its gap as well. Euro dollar trade a little bit lower. Didn't get down to the sell stops yet. Euro dollar trade a little bit lower. Didn't get down to the sell stops yet. That's what we're looking for next. And if we see any further expansion on the downside, we will be looking for the shaded area down to 107.70. Well, 107.80 will really round it up to that. And then down to 108. And we have pound. I said that since we were looking for euro pound to go lower, that would free up euro dollar to drop. And they would either keep cable either in consolidation or allow it to rally. So far, it's pretty much been consolidation with a slight little bullishness. Okay, it came up and took out these highs that we've basically retraced off that with nothing in terms of heavy selling. I'll come back to Aussie in a second. We have the dollar CAD, really amazing price action yesterday. I love seeing that. When we have a more liquid market and more symmetrical market, that's how our entries and exits are going to be. You'll see they're very, very precise, and we get our levels really, really tight. We're coiling, basically, consolidating ahead of, I think, the crude oil inventory numbers. We do have a liquidity pool resting just below these equal lows down here. So we'll be mindful of that today at the 10:15 session that we meet up at. So at the time of the recording being posted for this morning, I'll include an additional webinar link so you guys can register for that and be a part of that session. Hang on one second, I think this solid line. Okay, so we could see crude oil numbers drive us down into here. And for the Aussie, okay, so Aussie dollar here, I have the delineation set up for the day dividers. Let me get this little box out of my way here. It's always in the wrong place. There we are. All right, so we have two different things going on here. We have a 15-minute time frame. We were looking for a reason to get positioned to go lower for that daily fair value gap. And this is the 0 GMT delineation. And that opening price comes in at 73.40. The low is 73.39. So essentially we've opened and rallied straight from there. Okay. Looking at the 15-minute time frame, we have this void in here. We were in consolidation. So what's going to be resting just above that high? It's going to be buy stops. So they're going to want to expand price to get those buy stops if they're going to go lower. If it's a good short, they're going to want to take it up there and take it out. So either A, you sit up and watch London, or you sit up and you watch for the midnight opening price and you determine what you want to do based on that. If we look at the midnight right here, that opening price comes in at 73.62. So we're still inside the consolidation at that opening price and this opening price. So we're inside the consolidation. So ideally, we want to always try to sell in some kind of a rally. And if we look at the 20 pips above that opening price at 0 GMT, that takes us to here. Does that take us outside of the consolidation? I'm waiting for some feedback. 20 pips above the opening price takes us out of the consolidation? No, it doesn't. We're still inside this large, big block of price action. So if it's going to go lower and we're consolidating, chances are it's going to want to go higher first for some measure of buy stops to facilitate new shorts and then trade lower, if that's what we see unfolding in the charts. So we have the opening price here delineated at 0 GMT according to Forex Ltd's platform, and here's 20 pips. So looking over here, 20 pips, yes, you have a mean threshold of the bearish order block, but you have all of this up in here. At the bare minimum, if it comes up to this level here, that takes us outside the scope of 20 pips. So if we see things like that, we want to elect to go to what? No trade, or we look for what? Midnight candle in New York. That's this one here. So now we can take that opening price, project up 20 pips. Okay, what does that get us? It gets us real close to closing the void. But what's the rules? What's the rules for selling short, if we're going to go short, going into London, what's our typical first go-to for a stop loss? How many pips? There's a specific number. Leo's got it. 33 pips. 1/3 of the average daily range if we're going to assume it's 100 pips. Now again, obviously everyone knows that it can't be always 100 pips by the average daily range, but we use it as a go-to. So 33 pips from that opening price takes us right to there. Okay? So that's why that real little red line is sitting right here, because it's 33 pips away from the opening price at midnight in New York time. This last up-close candle on a 15-minute time frame, what is this in terms of PDA raise? What is that? Bearish order block. And it also closes in the entire void here. So if it's going to go lower, you can do one of two things. You can take the short on the breaker, 15-minute breaker here, because we have stops that rested just above these equal highs. Price came above that. You see that? We've taken out buy stops here. So we have a breaker in here. So you could sell short there and still use that same stop, or elect to, like I did, the opening on this up candle. It was a limit order. It hit it, and by the looks of it, it didn't go any higher. It went right to the pip. So 73.89. You can see 73.89 is the fill. So, and that was filled at 11:25.37. So that's what that is in terms of entry. The stop loss is at 73.52, and I have this level down here. I wanted to get out a little ahead of the middle of this consolidation in the event that we were, and it may not even drop for me, but I'm just saying, using what we gave as a case study, this is how we elect to go from 0 GMT, excuse me, 0 GMT for XLTD, or go to the midnight opening candle. If you're looking to go short, if there's a consolidation in here, we want to take everything above a consolidation. We want to see it trade outside of that. Now, if we would have saw it trade down during Asia out of the consolidation and created a void, then we could wait for it to come back up and close that range, kind of like this, but at a lower level here. But because we had both the opening prices at Forex LTD 0 GMT hour, the opening is inside the consolidation right here. So we have to wait for what? And ideally, to sell short, we want to see it rally. So yeah, we were seeing that, but 20 pips above that still doesn't get us outside the consolidation. So at the New York Open, we want to see price trade up again still, because we want to see it clear this consolidation. We don't know if it's going to close this entire void. We don't ever know that. I didn't know that for certain. Don't let me give you the false impression that you're always going to know this. Okay, but logically, if we're going to see price go lower, and it's going to be a significant price move lower, because we have a little bit of a move to come down into here, but we start consolidating. So consolidations doesn't always equate to consolidation and break down. Many times it becomes consolidation, trade back up, go back into some liquidity, take out some buy stops as you go up there, and then once you've picked up more orders, you can come back down and then trade lower. That's the ideal scenario. Okay, that's the real best outcome you can have. Hang on, bud. There's a lot of questions outside this conversation. Let me put the questions over here so I can get through this so we don't spend too much time on it. So we have the condition that we want to see prices trade lower on a daily chart. Okay, we also have, let's go create a new Aussie. And it's got to a daily. Okay, and zoom in a little bit. All right, so the opening's right down here at the low of the day. We had yesterday's down delivery on price and the previous day's low here. So we had the opening, it traded down to this day on, let me see what May 8th daily candle low of 73.77. So when the opening on the 9th yesterday opened slightly higher than the low of the previous day, we traded down through the previous day's low. Once that happened, we started seeing sell side delivery of price only, and we had a down close. The next day, we see it open. It trades up. We could reasonably expect to see it trade just to where we're at now because of the 9th of May's low, because we rebalanced that whole down day yesterday. Does anybody not get what I just said there? Because I may not have done it justice by saying it like I did. In other words, we saw yesterday's daily range basically rebalance. So if we had yesterday's entirely down day rebalanced, there's nothing that it really essentially needs to go. It doesn't need to go any higher. So that's why I have a relatively tight stop, because it shouldn't go up anymore. If it does, then I'm wrong. It's probably going to want to go up even higher, and I want to be out at that moment. I don't want to be holding on to the position at that time. Okay, so let's go back to our 15-minute time frame chart. Okay, so we have price coming back up into filling in all of this void that was created on the 9th. Okay, and then we had price trade all the way back up into a bearish order block seen here. Hang on one second. Okay, sorry about that. So we have the entire daily range yesterday. It was rebalanced, and our expectation is if it's going to go lower, it should not go any higher than yesterday's high, but there's a reason for it to want to come back up here and rebalance this, and it would be able to pick up more orders, willing buyers here to sell to, and then we could look for a move down into that fair value gap on the daily chart. So in summary, we like to look at what price has done in the previous day. Okay, if we were in a consolidation, which is what we saw later on in the day, on the 9th, that consolidation, if we're looking to go short, notice that we had really no movement down, creating any kind of void or any kind of gap. Okay, it was just basically keeping tight inside this consolidation. All this price action from London all the way through New York close was basically one big consolidation, back and forth, a Z-day or consolidation profile. So we had initial price swing, then in consolidation. So if we're looking to sell short, we can't just indiscriminately go in and sell 10 pips above the opening price when we have this, because there's a lot of layered areas where buy stops could be tripped. And if it's going to go lower, the ideal scenario is for it to go up, take some buy stops, and then reject that. But we have all of this inefficiency in terms of delivery of price only on the sell side. So we had to take that in consideration and use that in terms of time of day. So while we use the opening price of 0 GMT as a potential catalyst to get entry, 20 pips above that, using our rules from last month, doesn't give us anything to work with over here that would make sense as a premium PD array. So we wait for New York open. We do the same scenario. Look for 20 pips to 33 pips, because that's the average daily range on a 100 pip day. If we use that entire range up here, what do we see? Well, if we go 33 pips up, that's over here. But before that, we have this bearish order block, which closes this entire void. So that's why the limit order was placed here, and price went up and hit it. Now, admittedly, I thought for sure that it would probably go up just a little bit more above that. But in this case, I look like a rock star. For right now, it could change and go higher and knock me out, but it doesn't always give you this precise of an entry. I mean, it just happens that this is happening with the very high of the day for this particular moment in time for this daily range. If we have consolidation from the previous day and we're looking to sell short or buy, okay, don't use the 0 GMT hour unless it takes us outside through going into that 8 o'clock hour. If we make a move outside of consolidation, which it can happen, sometimes you can get a little bit of earlier move before 8 o'clock New York time. If that happens, then you can elect to use the 0 GMT hour. But generally, if you have a consolidation in here, you want to adopt the midnight candle in New York, because your chances are you're either going to get a Judas swing that takes you outside the consolidation, or it's going to filter you completely out of the trade. And there's a lot of questions and things that are being talked about outside of this topic. Does anyone not get what I just said? All right, so if we're looking for a daily PD array of a discount, that means we're expecting lower prices. We're expecting IPDA to want to trade down here to deliver price and rebalance the fair value gap on the daily chart that we've been talking about. Hang on one second. Okay, I just took 2 of them off, so that way I got something on, and I don't want to be knocked entirely completely out of this thing. So, all right, we have the expectation of daily Aussie dollar wanting to go down into our fair value gap on the daily chart. Our expectation, or my expectation, has been that we will most likely want to see dollar trade higher. That was our premise going in. Initially, we wanted to see the 99.65 level and then maybe look for continuation going through. We may get that later on today, but right now, I didn't know it was going to pause like this, and you aren't going to either. So going back to our Aussie, the expectation is if we want to get short for a move down into this daily fair value gap, ideal scenario is we want to see it create a move up. We want to sell into some strength. Where everybody else is going to chase it going long, we want to sell into that and fade that, because that's exactly what the professionals do. That's what the banks do. They have to sell to willing buyers. So we have to find buyers at a higher price. How do we do that? We find it in the form of running out old highs. So the price that we see here, we're going to use this 20 pip thing here, right there. Here's the high, 20 pips above that, because that's what this range is here. Let me show you. See that? It's 20 pips. It's 10 pips wide, but it's 20 pips high. Well, if you go 20 pips that high, go over here, essentially that's basically where we made the high today. But that's not enough. You have to couple it with a premium PD array. We have a bearish order block that closes in a void. So that all this gap in delivery on price, it's been only sell side. When price rallies up, closes that in, goes to a bearish order block, that sets the tone for a viable entry for going short and then positioning yourself for a move down to the fair value gap on the daily. So what I'm teaching you this morning is if you have an expectation, you want to get in a lower move on the daily, because we're looking to try to trade in a daily time frame or minimum 4 hour, the 2 trigger points we're looking for primarily are 0 GMT, or 8 o'clock at night right now in New York time, or the midnight candle in New York, that opening price. And we want to see ideally some measure of move above either one of those 2 price points. The question is which one do you use? Do you use the 0 GMT in Forex LTD, or do you use the New York? The way I determine that is based on the previous day's profile. If we're in consolidation, if we have a consolidation day here, generally I'm going to look for some measure of a move of 20 pips above the opening price of 0 GMT and see, is there something that would be able to frame that trade? There isn't really anything that strong, because to go up 20 pips from that price at 0 GMT, it only takes us to here. And if it's going to go there, why would it just stop there? It doesn't make any sense. There's nothing to take up there in terms of buy stops. There's no gaps, there's no voids, none of that business. So it went up there, yes, and consolidated. But then we went into New York's opening price, and then we created a little bit more rally and then traded right back down again, but then moved up. That's the Judas swing that we classically see at the New York hour in midnight, closing in this void. So in simplest terms, when I look to trade either long or short, if there is no consolidation like this, if it's a big consolidation or a choppy price range like this, I'm going to first confer with the 0 GMT opening price and see where that is. If it's inside the consolidation, I'm going to demand the 20 pips above that opening price is going to take me above the consolidation if I'm going to be looking to sell short, or below the consolidation if I'm looking to go long. If that range of 20 pips above the opening price of 0 GMT does not permit me to see that, then I'm going to wait. I'm going to take a nap, go to sleep, wake up right before midnight in New York time, and I'm going to see what the opening price is there. And then I'm going to add that same filter to that. I'm going to add 20 pips to the opening price at midnight in New York, and then I'll look for a trade idea to line up. In this instance, you can see it overlaps with a bearish order block from May 9th. Here on the 15-minute time frame, it closes in the void. Price trades right up into it and had a really nice reaction already off of it. Now, it doesn't mean that that's the daily high. None of this is ever cast in stone. It's not a panacea. It's not a be-all, end-all. It's not going to be perfect. It's not going to always work. I'm just telling you, this is what you're going to be met with when we're done working with one another. The criteria that we use is what I use here, that filtering process. So how do we know if 0 GMT is going to be used? If we have a lack of price consolidation, in other words, if we had a nice down day, then we came off the low and then small consolidation during the quiet period, then that's reasonable. Then we can look for an opening at 0 GMT, a rally, and sell short if we're bearish that way. But we have a consolidation in here, so there's going to be a lot of layered buy stops that they're going to really want to come back up here for. So in an ideal scenario, let me give you a different example here. Okay, so we have a day like, well, this is not a good one either, but nonetheless, this trades lower, and then we had to move completely all the way one-sided going into 0 GMT. So that's not a day where we would have to selling above 10 or 20 pips. It's going to be right at the opening, and yes, it looks like cherry picking, but the scenarios has already been proving a premium in the price. This day here, okay, where we had a move down, notice there's a lack of consolidation. It's just basically a nice trending day, and then the consolidation is late in the day going into 0 GMT. That's a better scenario for if you're looking to sell short, either sell at the opening at 0 GMT or expect that little bit of a move up. And here, same scenario, okay? If we saw price go lower, look what it does. It goes into a consolidation again, creates a range. So we would have to see price trade above the consolidation. Just because it's 0 GMT doesn't mean anything. There's going to be buy stops that they're going to want to take. Moving forward, they eventually come up and get them later on the next day, late in the day. Well, all these buy stops are taken here. Then you see some measure of a move lower, but it doesn't happen until a day later. Okay, that's a good question. Larry posts, which premium array did it trade from yesterday that prompted a short at 0 GMT today? Well, I gave you the context based on what we're seeing here. We had the consolidation in here. I wanted you to use the 0 GMT hour to frame a trade. So there was no premium PD array apart from running the buy stops, the void, the breaker, or the bearish order block. The choice is you could have done this one, selling short above this high here. There's nothing wrong with that one. There's nothing wrong with selling short at the breaker. There's nothing wrong with selling short at the bearish order block either. It's just how much of the range are you willing to use in terms of leveraging and where your stop loss needs to be. That's why it's a case study. You need to apply yourself to it. Why not the high stops? Scott, can you give me a little bit more detail? Which one you're talking about there? Now, I mentioned several of them and that are obvious, but there's also one staring in your face. Which other PD array could you have used? The gap resistance. The shaded area here, that's all the daily fair value gap that we were waiting to see price trade down into to fill. What did I tell you that's going to happen at a later time if price trades, if it trades back up to that? Once we move away from it, if it comes back up to that level, what should it act as? Resistance. So you have overlap of several different things here that should promote resistance in here. And if there's a willingness to want to go lower, participants should see price trade lower. So far, I'm not real excited about what we're seeing in here. I would have expected it to move a little bit more than we've seen here. So I'm going to take two more off and just leave one on. Now I don't care what's going to happen. If it comes down and takes my order here, great. If it doesn't, I don't care either. I executed, and if I don't get the continuation going lower here today, it may need today to determine whether or not it wants to go this week down into this daily fair value gap. It's not about being right. It's about preserving your capital, and it's about being able to take money when it gives you the opportunity to do so. What was I expecting? I was expecting it to come up here, close this void, maybe go a little bit above it, but still fill the limit order sell. And I wanted to see it break down and have a little bit more aggressive. I wanted to see these types of ranges here off of this level. I wanted to see large, big down candles, not all this wicky, spotty looking price action. In other words, it's not as convincing as I would have expected it to be off that level. So while it's giving me an opportunity to get something off on the trade, I would have been much more happier to see it have a larger range expansion away from that level. In other words, we're not seeing speed, we're not seeing magnitude of distance, and we're not seeing conviction on the sellers right now. So while we did have a level that makes sense logically, we're not seeing the fingerprint or hallmark signatures that there are big players trading short at that, essentially the 73.85 level, we'll call it. Now, if it starts to pick up, great, but I would have expected it to move a little bit more one-sided lower by now. All right. Yeah, there's a lot of questions about other pairs that has nothing to do with this conversation. I don't mean to be rude by ignoring you, but when we're talking about one thing, I kind of want your focus there. All right, so I can move my stop down to +1. Yep, one pip. So now basically I have what nobody agrees it exists. I have a free trade. There's nothing that, well, essentially this is really a free trade because it's in the demo, but nonetheless, that's how you manage a position. You look at it, see whether or not there's conviction behind it. My take profit is not right. What's wrong with my take profit? If I'm looking for a move below this low, it's going to go lower, and it fills the limit order here. Because I don't expect it to go much lower than this low, because it could stay in this consolidation. In other words, if we look at the equilibrium, okay, we have the range here. Equilibrium's right here. So if I think price is going to drop down from this level up here, if I think price is going to drop down below this low to take this sell stops, and if I think it's going to touch the equilibrium, I have to factor in the spread. So by adding the spread, that puts me up here. So I have to take the target at a higher level than where I think price is going to print. Remember, you always have to factor that spread in. And because it may not be a day where it takes out the previous day's lows, I only want to take an area where it makes logical sense for the sell stop to be ran out. So that's why it's sitting right here. All right, so again, there's a lot of questions about pairs I'm not even following. Okay, Angela, sometimes you go wick to wick and others are body to body on those fibs. Why? So why wick to wick on Aussie dollar? Because it's the entire consolidation of this range in here. And this wick is kind of like really close to this low anyway. So I kind of want to factor that entire range. Even though this is a run on stops, I got to still factor it in because that's where the targets are. If I'm short, they're going to want to go below that low. Now, if I'm working inside of a range and I don't expect that range to be traded outside of, then wicks aren't going to be the big deal. It's going to be the bodies. But because my expectation is bearishness on Aussie dollar, I want to see it trade down. Ideally, in a perfect world, I want to see it trade below that low because there should be liquidity down there. But I also have a barrier that I have to trade through that I don't know for certain it's going to do that. And you won't always know that either. So by having that in mind, by including that in our observation about equilibrium, our low to high, that equilibrium price point resides right there. Now, if I use the bodies of the candles, the lowest close or open, that's here and here. Now, if I felt that the trade I was taking was going to work within the extreme low and high end of that consolidation, then I would use the bodies and not the wicks and wouldn't be considered worrying about that. But because I'm expecting, the trade idea is that I wanted to go lower to this area here on the daily fair value gap. So I want to incorporate that low at wick because it has liquidity below it. So you have to have that incorporated in your analysis of equilibrium. If we don't expect an expansion outside the range, and the trade idea was trading inside the range, and we're looking for a move that would be I'm trying to see if I can give you a definition or it makes sense. Say this is the daily high, and I'm really going to probably trip these up, but let's say this is a daily high, previous daily high and previous daily low, okay? And the next day, we saw it trade down here in a bullish order block, but I didn't think that the daily range was going to be broken with this high or this low, but I was going to be bullish. I could use the fib as we have outlined here, the body to body, okay, and then look at the reaction here, 76% retracement, optimal trade entry. You can get long, bullish order block, expansion up to, trade to the body as a rejection block, and you would take profit there. To kind of make sense of what I'm saying in regards to using the fib wick to wick, it's based on what we're expecting. If we're looking for a move outside of the range, you have to incorporate the wicks. If we're looking to trade inside of a range, I don't care so much about the wicks because those are areas at which stop runs have been made. So I'm looking at the bulk of the volatility, or volume rather, by looking at the bodies of the candles. I would like to have more consideration about the bodies and not so much about the wicks because the range is more closely defined by the bodies, not the wicks. But because I'm expecting move lower based on that lower fair value gap on the daily, it's essential that we have that wick incorporated because there should be sell stops below that anyway, or liquidity. So I'm not sure if I did a fair enough job in answering that, but that's the best I can do. Okay, good. All right. I'm not talking about the Mexican Zimbabwe cross. Oh man. All right, so the study for today is electing whether or not we're going to use the 0 GMT or the midnight candle in New York. And the easiest way to filter that out, I'm not saying it's easy to do because there's going to be times where you just feel really impulsive. You want to take the trade. You feel a gut, tug that you're going to be right, and you're afraid to take the sidelines until a better scenario unfolds. That's going to happen to you, and it happens to me still today. After 2 decades, I still try to outthink the concepts, and every time I try to do that, while I may get once in a while rewarded for stupidity, I will invariably regret it more times than be thankful that I did it. So the best scenario is wait for IPDA to provide the clues to you. If we have a previous day's consolidation, as we outlined here for Aussie dollar, the best scenario, if we're selling, we want to see it say trade above a previous intraday high. And the ideal scenario would be to trade above this high. So if it's going to go above that high, and say there was no void here, okay, say there's no liquidity void here. If that didn't exist and was much more efficiently traded lower, that would be the sell right there, just above that high. But because we have this gap and a short-term high, remember what I said about ideal turtle soup scenarios. The ideal scenario to sell short on a previous high is if there is a gap to the left of it. If there's a gap or a liquidity void, that's the best scenario because you have two things going for you. You're going to run for the buy stops, and it's going to come back up and offer free fair value. And that's what we're seeing here. We're seeing price trade above this, taking the buy stops. We've already seen 20 pips above that. Essentially takes us up into here. But then we go right back up to the, excuse me, the premium PD array of a bearish order block. So you have an overlap of several different things. But the main thing I want you to learn and take away from today is using zero GMT is not a secret silver bullet. Okay? It's not going to fix everything for you. It's not going to be, well, okay, now I know it. I'm done. I don't need to know anything else. No, there's some things you still have to consider and you have to factor in. But it goes along with market profiling and reading institutional order flow. So by using your PD array matrix and using it in conjunction with the daily expectation of this lower delivery on price because it's inefficiently traded here, if it's going to go lower, this is where it's going to go. So if it's going to go down there, ideal scenario is let's take some people out that are already positioned short. So they hold price in a consolidation. And what that will do is invariably force traders to lower their stop loss. Price will then expand up, take those stop loss orders out, assume more new shorts at a higher price level, and then ride to a lower level discount PD array on the daily chart. All right, so why don't you keep the last portion as a one-shot, one-kill since it fits the weekly template? Because I'm teaching you day trading, and I'm not trying to do too many things outside of that right now because we didn't get too many examples last month, so I want to focus primarily on this. All right. That's about all I got for this morning. If I go any more, we're just going to end up deviating and going into different topics. So I wanted you to kind of like use the information I've given you today and focus primarily on this example. And then also go back and look at times when there was a previous anticipation based on price action. And yes, you're going to have the benefit of hindsight for this, but it's okay. You're going to learn it conceptually. When you expect price to trade lower, we're always anticipating some measure of protraction on the upside or that Judas swing up, either at the zero opening or the midnight candle opening in New York. Either one of those two prices are our filter, but I want you to look at the previous day's profile intraday. The days that create consolidation, Z-day, or real choppiness, they're not ideal scenarios to sell short at the opening at zero GMT or just above it. Many times it requires price to trade above a significant previous intraday high for buy stops, and then you see that move lower. Vice versa, if we see the market wanting to go higher and we have a nasty sideways consolidation in the previous day, it's not an ideal scenario just to buy or just simply 10 to 20 pips below the opening at zero GMT. On Forex LTD's platform. We don't use it indiscriminately. Many times in that instance, we'll look for price to trade down below an old low in the previous day's range, and that's an ideal turtle soup because what it'll do is now everyone is looking at these levels. They'll have their supposed highs and lows in support and resistance. Okay, and they'll define it like this. Okay, so prices in consolidation. If it goes above this high, they want to buy it as a breakout. If it goes below this low, they want to sell it as a breakout. Well, since Aussie dollar has been in a downtrend, ideally, if we're looking to sell short and we're in, I said that wrong. If we are in a consolidation and say we thought that Aussie was bullish because it went to a daily bullish order block, and there's a lot of weight placed on that since I've released bullish order block ideas and such. Folks will look at that and say, okay, I'm going to, I mentioned that Adam for a reason because I noticed a few people, I got an email from one of our members, and also it was great to work with this example for that very reason, because if you see price trade down to a discount array, but it still has a lower objective down here, fair value gap. That bullish order block will be a catalyst for short-term bullishness, but you only are looking for a retracement idea. So yes, it frames the idea that we can see a bounce, but it could be a dead cat bounce. It could be just a simple little retracement up to another logical premium array to go lower, which is the context of what I used on this idea here. So I think I deviated, didn't make my point I was trying to make earlier, but let me try to do it again. If we're bullish, say we were bullish and we were in an existing uptrend and price traded down to this daily bullish order block on Aussie dollar. If we saw that, okay, in an ideal scenario, okay, we could eventually see this consolidation trade on new day at 0 GMT down below the previous day and dip deeper into that bullish order block, taking out the sell stops, but everyone else will see that breakout lower as a continuation, like a bear flag or just a pure breakout move. We'll be looking at as accumulation of willing sellers that we can buy from. And you have to use that profiling concept of what the previous day's range looked like. In an ideal scenario, you want to see price already be moving away from a consolidation, not starting a new one. Because if it's starting a new one, what they're doing is they're letting price stay close to a predefined range, high and low. And invariably, what they'll do is they'll control the thoughts of traders by lowering their stop loss down. Because as it's consolidating, it didn't look like this big consolidation right away. It just looked like that at first. Then we had this. Okay, now, okay, we failed to go higher here, so now we can go short. So they start selling it. Sell, 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 sell. Uh-oh, the brakes have been put on. Oh, no, we're okay. And it can't go any lower. Wait a minute. Well, let me lower my stop loss. Everyone that's sold back here or back here, their stop loss is logically right above this high. The consolidation does that. IPDA will bring that down to draw in open float to a new lower low, or a lower high rather, and it brings it to here. And that's why we see this attempt to run up, and now we come all the way back up to an area of premium, rebalancing price, and logically it should move lower. But because of the speed aspect that is lacking in here, and the magnitude of how many pips it wants to move once trading here, it's too lethargic for me. It's only essentially worked about 15 pips or so from that high, and I would have rather seen it already taken at least this short-term low out, but it hasn't done that. So that's why I've taken the majority of the position off. I only got one mini here to see if I'm going to get anything else out of this this lemon, but I think I probably juiced it for all it's worth for at least the New York session for right now. If it goes up and takes a stop, I could care less. I wasn't right. I wasn't wrong. I just executed it and followed the process. But I'm going to close this one here. There's a lot of questions. Again, still has nothing to do with Aussie dollar. No, I'm not going to look at any other pairs right now. We're going to focus on the dollar CAD in about an hour and 20 minutes from now. So when this session gets put up on the forum, give me about, it usually takes about an hour to do the compression and upload. So it should be up there at 10 o'clock, both the link for the 10:15 session and the recording here. Don't watch the recording. If you came in late, don't watch this recording. Just be present for the 10:15 session, because we may see something in the dollar CAD that we can participate in. If you're just watching this recording, you'll be distracted. Okay, the recording will be there. You can watch it later on in the afternoon. But I will see you all in about an hour and 20 minutes or so, a little bit less than an hour and 20 minutes. At 8:15, we'll be joining one another for about a 20-minute session then. Until then, wish good luck and good trading.